Volatility in the markets continue, and although some of my investments are in the red, I've not let it get me down, and what I've actually been doing is seeing this as a rare opportunity for investors to buy companies at a discounted price. After following the markets and taking some time to obsess over the latest season of Stranger Things, which was pretty awesome, I've been taking the time to reevaluate my position in the defense industry. As world events have caused many defense companies to rally and possibly end up in a correction in the future, I've put together some key information for you and identified which companies I think offer the best value to investors. Plus, I'll be explaining why I've rotated one of my longest held positions and which stocks I'm buying instead. Here we go. The defence industry can be a controversial topic for some, as if you look in certain areas you are bound to find arms being supplied to some locations you might take an exception to. So if you can't handle the cognitive dissonance, then this might not be an industry for you. As much as I hate the horrors of war, for those who like to take an anti-war, anti-arms, hug-a-terrorist stance, that benefit exists as a privilege of living in a free democratic society, a country able to defend its constitutions and freedoms thanks to the support of the government and military capability. There are plenty of countries who not only think differently, but want to destroy our way of life. It was one thing when we had to watch out for the Taliban or ISIS, but with Russia and China and their totalitarian ways making a direct push against a free world, they are challenging our ability and our willingness to defend it. Considering Ukraine, a starting gun for Putin's invasion was the Trump administration's lack of support, including a $400 million defense package that could have discouraged Russia's actions. And now we're looking at a war that is expected to last for years, with the US pledging to support Ukraine throughout. In China, Xi Jinping wouldn't hesitate for a second to invade Taiwan if it weren't for the US having already pledged to protect their independence militarily.
Yes.
You are?
That's the commitment we made.
China is watching the situation with Ukraine intensely as a representation of how capable the Western alliances are in defending their stance on global democracy. But we know from the USA's exit from Afghanistan how reluctant they are to enter into another expensive war, and this leaves a large defence hole for other Western alliances to fill. With global military spending reaching a record $2 trillion in 2021, 20% of this figure comes from Europe, where countries have been bolstering their defences in response to the Russian annexing of Crimea. 14% was spent by China with their escalating military presence across Asia, and in 2020 Australia responded to what they called a poorer, more dangerous world and rise of China by pledging $270 billion to be spent over a 10-year period, with particular focus on their naval defence. The USA remains the biggest contributor with $801 million spent on defence in 2021, and in March alone the country attributed a $13.6 billion aid package for Ukraine. So with budgets on the rise, I've done the research, I've gone over the fundamentals of the top defense companies, and I've narrowed it down to 3 of my top investments. To understand this, here's a breakdown of how these companies are playing a role in current world events. The defence industry can be quite incestuous, with various military products being collaborations between separate companies, so I'm going to break down the industry by focusing on the areas they are operating in. With Ukraine being the most significant war in the world right now, let's start there. If you've been watching any coverage on the war, then you would have noticed how Russia's strategy was initially based on a practical invasion with their tank fleet, with an expectation that they could win within a matter of weeks. Putin failed to account for mass corruption in military leadership and unmotivated and poorly trained military personnel, outdated, poorly designed military equipment and supplies, and pitted this against a country highly motivated to fight back and the Western world more than willing to support them through military supplies, with over $3.4 billion worth of weapons sent by the USA so far. And this is where we can be very specific, because if you've seen the many videos of Ukrainian soldiers blowing up tanks, you've most likely seen the Javelin anti-tank missile missile system, a joint production between Lockheed Martin and Raytheon Technologies, two of the world's largest defense contractors. To date, 5,000 of these weapon systems have been supplied, representing 1/3 of the USA stockpiles. Lockheed CEO Jim Taiclet told CBS News in May that they are aiming to nearly double their annual production from 2,100 to 4,000 units. This may take a couple of years to develop due to production and material shortages, particularly when it comes to semiconductors, as each missile needs a shocking 209 of them. Those surface-to-air missiles you may have seen shooting down Russian helicopters are likely from the FIM-92 Stinger missile system, a lightweight, rapidly deployable system that can be used against cruise missiles and all classes of aircraft. And as of March, over 2,000 of these have been sent to Ukraine so far, and since June, through the $40 billion additional Ukraine Supplemental Appropriations Act, the USA granted Raytheon a $624 million accelerated production order for 1,300 more units. However, in April, CEO Greg Hayes of Raytheon said the company was in quite a pickle, as the USA had used up a quarter of their reserves so far, and material shortages are preventing them from manufacturing more until 2023. The company's president, Wes Kramer, said they are working with the US Army in an effort to meet demand. In April, the US donated 108 M777 howitzers. This is a mobile artillery unit capable of firing GPS-guided munitions up to 40 kilometers and manufactured by UK defence company BAE Systems. On July the 1st, the Pentagon agreed a $820 million military aid package that included advanced mid to long-range missile defense systems and counter-artillery radars in response to Russia's long-range missile attacks, which is bringing more business to Raytheon through their National Advanced Surface-to-Air Missile System. Developed in Norway, this system can target stationary and mobile targets from a range of 50 kilometers, and is the same defense system used to protect restricted airspace around the White House. In June, UK Defence Secretary Ben Wallace announced Ukraine would be supplied with an unspecified number of M270 multiple launch rocket systems. Developed by Lockheed Martin, they can fire 12 surface-to-air missiles in a minute with pinpoint accuracy from a range of 80 kilometers. Ukraine started using their new long-range systems in July, and these have had a devastating effect on Russia's forces. Fuck those guys. However, it's because of how vital a role semiconductors play in defense products that the US Congress are having to rethink their reliance on foreign chip manufacture. They are currently trying to pass the Bipartisan Innovation Act to invest in domestic design and manufacturing of their own chips and reduce foreign reliance. Another area of interest is the Asia-Pacific region, namely Australia, who have been expanding militarily in response to increasing hostilities with China, and they have been particularly focused on their long-range missile defense systems. One such weapon is Lockheed Martin's AGM-158C long-range anti-ship missile, and the company secured a $800 million order from Australia to bolster their naval defences as part of their 2020 Defence Strategy update. The missile has a range of over 370 kilometers, making it a significant upgrade from Australia's current AGM-84 air-launched Harpoon anti-ship missile, which only has a third of the range, having been introduced back in the 80s. Also, one of Australia's most significant military providers is BAE Systems, a UK-based global manufacturer and supplier in air, maritime, land and cyber defences, who have been supporting Australia since 1953 and have grown into the 6th largest defence supplier in the world, and they are a partner in some significant defence projects, including Lockheed Martin's F-35 fighter aircraft series, which is built in partnership with BAE and Northrop Grumman, both of whom have secured contracts to support Australia's Joint Strike Fighter Maintenance Hub in Williamtown, where they will provide maintenance, repair, overhaul and upgrades across the Asia Pacific for military aircraft, with the F-35 design and production work alone being valued at around 1.38 billion Australian dollars. Since June 2018, BAE secured the $35 billion C-5000 Future Frigate program, in which their Type 26 global combat ship design will be used to construct 9 anti-submarine Hunter-class frigates for the Royal Navy. BAE selected Lockheed Martin and Saab Australia as combat system partners in the construction, with Lockheed introducing their Aegis fully integrated combat management system that provides simultaneous land, sea and underwater defences with full 360-degree 3D tracking capacity. But BAE's involvement in Australia represents just 4% of their overall sales, and they have more significant business across the USA, UK and Saudi Arabia, representing 9, 4 and 2.5 billion pounds respectively. BAE maintains and supplies Tornado jet aircraft to the UK's Air Force and provides operational capability to the country's air and naval forces. That's on top of their involvement in the design, manufacture and support of key military aircraft from around the world, with their air division making up 39% of their sales. Against the US Department of Defence and the UK's Ministry of Defence, Saudi Arabia are BAE's third largest customer, representing 12% of sales. After securing massive multi-year contracts between the UK and the Saudi governments as a subcontractor, with revenues partly guaranteed by the involvement of the British state. The country accounts for 29% of BAE's air division, the largest single destination for its military aircraft. The company's current outlook includes a £44 billion backlog with good order intake expected for 2022 from their continued operations, and based on 2021 performance, the company rates themselves as the 7th highest defence contractor in the world. Now, with a few companies mentioned so far, there is much more about the industries that could be talked about, but time is a factor. So as usual, this is where I'm going to try and go over all the financials to explain which companies are offering the best opportunities for investors. Having gone over a massive amount of data, I'll be breaking this down by focusing on the few companies that I think offer the best value. For starters, in today's market, you cannot be a loss-making company. You need to be growing in returns and beating targets, or you're dead in the water. On that basis, there are a few companies I can remove straight away. Safran, British Airways, and especially Palantir, which although their revenue is climbing, net income remains in the negative, and stock performance reflects this. With the losers out, we have better choices, and one thing to point out straight away is that the dip here is a result of the merger of Raytheon Company and United Technologies to form Raytheon Technologies. The remaining companies have some pretty decent profit margins, with BAE, Lockheed Martin, Northrop Grumman and HEICO in particular having the highest with an impressive 16.54%, but they are a tiny company by comparison, with a market cap of just over $16 billion, trading at over 56 times earnings. So when comparing the fundamentals to the group, they are way off the chart in terms of value and too expensive for my taste. With the choices left, I don't like to buy companies trading over 15 times earnings, especially with companies with a PEG ratio over 1. But all these companies are seeing momentum brought on by recent world events. So the question is, which companies are trading at fundamentals that represent the increased value and growth of the company, not market sentiment? BAE stands out as the cheapest, and it's a company I've been buying for a few years ever since tensions with China were heating up. And most recently, the stock has become more volatile with the situation in Ukraine, as investors seem to be cashing out on perceived highs only for the stock to bounce back. The stock is up over 46% year to date and over 51% trading 12 months, which is a far jump from trading sideways for the past 5 years. This record stock price was followed by the company announcing a pay rise of 6.75% for nearly 30,000 of their staff, with a second pay rise of 6% to follow next year. It's a great example of a company responding to the needs of their employees compared to the many companies right now who are seeing strike actions in comparison. The company's revenue to net income is growing at a steady pace, but of particular note is the earnings per share, which has been growing rapidly since Australian expansions, which can explain the company's increase in assets and shareholder equity, which have been on a rapid incline. Since things heated up in Ukraine, I've also been using a leverage ETF to increase my position and profits by a margin of 3, which I covered in my previous video about leverage, and this has doubled my original profits over the course of the last few months. However, this is not a strategy for everyone, and I think the stock has recently rallied to a peak. I have concerns about BAE's increase in long-term debt, and I'm particularly not happy that with all this growth, the dividend has been moving at a very slow rate. Although at £8.24 per share, it still sits at a market-leading 3.10% yield, which is great for investors who love a dividend. However, as with any industry, it's important to reevaluate your positions, and with BAE trading with similar metrics to Lockheed Martin, when it seems a lot of their recent growth stems off the back of partnering with them, it seems logical to take a look at the bigger American cousin. Looking at their earnings, Lockheed Martin have been performing exceptionally well over the years, hitting over $67 billion last year, and compared to the others, are on a consistent growth pattern for the last 8 years, aside from 2017 where the company's profit margin fell to 11.7% and a net income fell by 61%. This is largely due to a fall in operating profitability from the company's space division, which fell from 18.7% to just 9.7%. The stock saw a moderate drop of 6.8% in March when Bloomberg reported the US government would be buying 33 fewer of their F-35 jets in 2023, compared to 142 units last year, which was 3 more than planned. It seems investors were quick to overreact as the drop is small in comparison to the overall business. Lockheed are still planning on delivering 151 to 153 jets in 2022, and even with the US reducing that order, Switzerland and Finland will be buying jets for their new fighter programs, with Finland in particular planning an order of 64 jets in a $9.4 billion deal. Lockheed does have a long history of operations, but one that has seen many legal scandals across generations, with 81 in the last 21 years alone, including overbilling defense departments, revealing classified information, bribing government officials, project cost overruns, improper disposal of hazardous waste, and many more. But the company has powered through these cases simply because this type of activity has become common practice in the industry, and Lockheed have become indispensable to the US government in defense and civil services. The company spends millions annually lobbying, influencing government decisions, and when it comes to allegations of illegal activity, they have a history of paying millions to settle. Lockheed has become so powerful and influential, it's too big to fail. But as with many industries, Lockheed stock will fall in line with any market crash, but at times of warfare, such as 2001 into 2002, and with world events as they are now, the stock seems to rally and come back stronger. Despite these setbacks, Lockheed Martin has powered through, growing their revenue consistently, and net income has been returning to market-leading levels. The company has been growing in assets, and shareholder equity has been climbing at a rapid rate, whilst Lockheed have been using funds to pay down debt and buy back stock at a decent pace, bringing more value to shareholders. The company fundamentals show the stock trading just below 18 times earnings, and although this means it's on the more expensive side, this is a company that has provided more or less consistent growth over decades. Compare this to earnings, and despite the drop in earnings in 2017 to 18, price to earnings has grown at an acceptable pace. Compare this to Tesla, for example, which is a prime example of how massive jumps in price to earning ratios often result in a correction. The company is expected to follow a compound annual growth rate of around 1.44 to 5.94% over the next 5 years, and the consensus from analysts leaves the current $419 a share with a growth margin of around 15%, which may not blow anything out of the water, but this is a company that continues to grow over the long term. It has strong operations and continues to secure high revenue contracts from key governments. And when it comes to dividends, the company has been increasing this amount on an annual basis, and with such consistent growth, it's almost pornographic. And whilst I'm looking at the stock trading at $419, that's a yield of 2.67%, which is great news to investors who love a dividend. And finally, we have Northrop Grumman, the 4th largest defense contractor in the US, and the reason this one stands out for me is that if we take out the giants and focus on the small cap companies, you can see they are leagues ahead in terms of annual growth. The company has a large portfolio of space technology and ties to nuclear defense systems, including stealth bombers, missiles and submarines, and they have been tasked with modernizing the USA's ground-based strategic deterrent, replacing the country's Minuteman-free ICBMs with next-generation technology, providing a vital nuclear deterrent that I hope will never be needed. The company has just come out of a bad quarter, reporting total sales of $8.8 billion, which is a 4% decline from the $9.16 billion recorded in Q1 last year. Net earnings fell 56% from $2.19 billion to $955 million, but these drops are largely a result of labour shortages and COVID-related supply chain disruptions. And of note is that these were limited to their traditional defence sales streams, whereas space systems were up by 13% to $2.85 billion, compared to $2.52 billion last year. CEO Kathy Warden noted that the defense spending in the US is only growing at a rate of 4 to 5% a year, despite growing threats across Europe. In contrast to NASA's budget request for 2023 rising by 8%, as the government is leading towards more space-based defense and exploration. For Northrop, they are leading the way in government space security efforts and are seeing a boost to their development programs, which include a $1.1 billion boost to GBSD and $206 million on their next generation interceptor. Space Systems are expected to continue as one of their largest revenue producers, as their portfolio already includes a $692 million contract with the Space Development Agency to produce 42 low Earth orbit communication satellites for a mesh communications network. On top of the 2020 $2.3 billion Space Force contract as part of their next generation overhead infrared program to develop missile warning satellites, with another contract expected for production and integration expected in 2022. Further $341 million contract came from the Space Force in February for Deep Space Advanced Radar capability to advance global situational awareness. They were included in a $2 billion contract from Boeing and Lockheed Martin for GEM 63 rocket boosters to help the United Launch Alliance launch Amazon's Project Kuiper satellites, plus a $930 million contract with NASA to provide their Halo Outpost module for use in Project Artemis, which will orbit the moon as part of a plan of long-term exploration of the lunar surface and deep space. There's also the Surface Electronic Warfare Improvement Program for the Navy, which was originally initiated by Lockheed Martin. Block 1 providing electrical enhancement to existing ship warfare systems to improve their anti-missile defense, counter-targeting and counter-surveillance capabilities, which since 2009 was replaced with the Block 2 system, which upgraded the antenna, receiver and combat system interface with early detection, signal analysis and threat warning. Since September 2020, Northrop Grumman and the US Navy Program Executive Office Integrated Warfare System are developing Block 3, which will upgrade Block 2's abilities by the addition of a high-end electronic attack capability, as well as other ancillary functions, including early detection and possibly long-range, high-bandwidth communications using a new active electronically scanned array emitter. The system will introduce non-kinetic electronic attack options that allow them to seek out and destroy those threats. It uses blasts of precise radio frequency energy that can be continuously fired at multiple targets, and as it doesn't use kinetic ammunition, it can in theory be fired an unlimited amount of times. Northrop's first two systems were developed in 2018 under a $26.6 million modification to a contract with the Naval Sea Systems Command. Last year, Northrop was able to secure a contract worth up to $1.16 billion for further systems, which includes $101 million from last year, along with $254 million this year for further development. Lockheed delivered over 100 of their Block 2 systems, and assuming each Block 3 system is priced at $13.8 million, that's a potential market of $1.38 billion if Northrop were able to upgrade them all. And if Northrop are able to follow through with their plans to scale the weapon to fit larger and smaller ships in the fleet, the value of that scale production could increase to billions more. Just over the last 5 years, they have seen their revenue grow 37% from $26 to $35 billion, and that's with net income to shareholders following with a jump of 243% to $7 billion last year. It's incredible to see how the company has been able to overtake the competition in terms of earnings per share, and as of last year, they continue to grow in assets, maintaining a strong cash position and consistent equity. Analyst ratings predict the company to grow at a compound annual growth rate of 3 to 11%, and although such reports might have the stock mostly priced in at present, I think the company is on the verge of blowing up as they gain some key contracts over the next few years. And to top it off, like Lockheed, they maintain a policy of returning free cash, such as the $2.1 billion in 2021, back to shareholders through stock buybacks and a dividend that has been growing each year since 2004. Priced at $475, this amounts to a reasonable and reliable yield of 1.46%, which is great news to investors who love a dividend. Warfare is a complicated and incestuous industry, and it's taken a lot of time to put all this information together. Now, there are other companies I haven't covered in detail, Raytheon, L3Harris, etc., that have their own roles in the industry, but I focused on the companies that show the patterns of growth that I look for in investment. I think these three companies are showing strong positions in the market, good organic growth in their earnings and stock price based on their productions and contracts, not market sentiment. Comparing these three to the S&P 500, they are not immune from market crashes, but as the defence industries recover over a general bull run, they have had a much faster recovery than the competition, with Northrop in particular outperforming the S&P during its current downturn. If I had to summarise these three companies, I would say that BAE offers the greatest value, Lockheed offers the most sustainability and long-term growth, whereas Northrop Grumman offers a more speculative entry into the most advanced area of defence and could be a stock that blows up over the next few years. As part of routine rotations in my portfolio, I have moved out of my BAE positions as I felt the stock has climbed a little too far too soon, and I may consider taking on BAE again if it comes back down, the dividend improves, or the others become too expensive to continue investing in. For now, it's back on my watch list, and I'm building my positions with the other two a bite at a time to balance out the current volatility in the market. Overall, I think these companies will stand the test of time, responding to the growing world hostilities and returning profits to shareholders over the long term, and that's pretty good for investing. So that's my take, and if you like what you see and you want to see more, please smash that like button and subscribe so you don't miss out on future videos. And if you have any thoughts, please comment below, let me know, and I will take some time to respond. Until next time.